Good afternoon, everyone, and welcome to another one of Option Hotline's free trading webinars. We are here this afternoon to listen to Chief Options Strategist Keith Harwood, and he is going to speak with you all about what strategies he's looking at in this new year, 2023. Thank you all for being here today. I know you're coming from all over, not only the United States, but all over parts of the world, so we are grateful and happy to have you with us today. Please take a minute to read through this disclaimer and feel free to click the links to get additional information should you want it. Keith is going to pop on here. Keith, are you with us?
I hope you can hear me, but yeah, I think I'm with you.
There you are. Yes, Perfect. I can hear you. Wonderful. Thank you for being here this afternoon. We are excited for your presentation. I want to let everyone know that Keith is going to be pulling up his presentation to begin any minute now. While he's doing that, if anyone has questions for Keith during his webinar presentation, please feel free to type those questions in the Q&A box or the chat box, and I'll get those questions over to him at the end of his presentation for him to answer live. So right, Keith, whenever you're ready, you can go ahead and take control.
Perfect. We'll do so now then. All right, hopefully I got the right screen.
Yes, I can see it. It looks wonderful. So whenever you're ready, take it away.
All right, and as Natalie mentioned, if there are any questions throughout, please throw them into either the chat box or the Q&A. I will do my best to answer through, during the presentation. But if I miss something, we will come back to it at the end. Make sure that to the best we can, we will answer as many questions as possible. We've got a big crew today, so probably a lot of questions. So if you do have a question that does not get answered, I'm going to have my contact info here in just a moment. Make sure you email me and we can always follow up. So thank you again to everybody for joining today for What I'm Watching in the New Year. This is usually kind of a fun topic point for the start of a new year. We get a lot of new trends starting in that first few weeks as investment managers start to deploy capital, and then we can start to see what the market may be setting up for in the year to come. It's an interesting predictor of the full year, and so far I think that we've seen maybe a little bit of what we saw at the end of last year, a little chop, but in this case a little bit of bullish behavior. Now, before I get into the actual commentary on the trends and the options and everything else, I also have to give out my disclosures. Lawyers say that I have to, so I do. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Nobody at Option Hotline is an investment advisor. We're not registered with the SEC. If you have questions about your personal account, you should contact a registered financial advisor. That's not what we do. We provide the education, we provide the information, and we provide some examples of how some professional traders might trade current market conditions, okay? So please reach out to your registered financial advisor in order to answer any questions about your personal account. I'll give you another moment to read through these, and then we will get into the actual content itself. All right. For those not familiar with me, and I see actually a number of new names today, so that's great. Thank you for joining me. I am really happy to talk to people that I've talked to before and also talk to new people. I started in the CBOE pits back in 2005. So it's been, what are we now, 18-ish years of trading experience, going through trading as a market maker, as a proprietary trader, and as a hedge fund trader. So I've gone through kind of the whole gambit of it. I decided back, I guess it's been 5 years, 6 years now, that I really didn't like necessarily working for those institutional guys and working for those big money managers. I preferred to try to help other people understand where the inefficiencies in the markets could be and try to trade smarter. So I've done, the trading route, as I said, through the market maker, proprietary trader, and hedge fund trader roles. I joined Option Hotline as the Chief Options Strategist in 2018, and I've traded as an options trader, equities trader, fixed income trader, fixed income options trader, commodity options trader. I've basically traded almost everything you can come up with. And I think given that big basket of knowledge, I think there's a lot that I can share with everybody, and hopefully I can help you all in any way or any shape here. And if you have questions throughout your trading career, I am always happy to have you reach out. And that's why I give everybody both my email, keith@optionhotline.com, and my direct phone number. Now, most people do not give out their direct phone number, but I always like talking about stock markets. I guess I'm a little bit of I'm a little crazed about the markets. I think they're always interesting. I think new ideas can always trigger another new idea, a new trading strategy, something of interest. So if you have questions, call me. Generally, during market hours is easiest to get a hold of me, but I'm actually usually available almost all the time because I guess, love the markets too much. That's why I do this. Make sure you keep an eye out for webinars at optionhotline.com to receive my free giveaway. You might have it hit your spam folder. Some people have had that issue. So make sure you're watching your spam folder over the next couple of days. Natalie mentioned ways to whitelist. And I think if you go to optionhotline.com, you can get other instructions on how to whitelist that email address so that it does not hit your spam folder, because we're going to have some follow-ups with freebies. And free things are usually good. I think they're helpful, and the stuff that we give away for free is, I think, worth more than zero. And I hope that they help you with your trading as you go through. So what are we going to talk about today? I want to talk about the current market technical setups, the current market volatility setups, just a touch on that. And then we're going to talk about option strategies for the current market setups, given where we're at. Okay. And then what sectors, and actually not just which sectors, but which stocks look best for each of these current market setups. So we've got some really interesting stuff coming up today. I've got some individual stocks that I am following for my subscribers that I think are going to be of interest to you, and kind of a free teaser of what you can get with a little bit of extra work into the market and a little bit of extra analysis. The first thing that I'm looking at right now is the long-term trend. There hasn't been one for months, right? If you guys have been watching the markets, you would say we go up, then we go down, then we go up, then we go down. It's been really since maybe September that we've really had nothing going on. When we catch a trend, it's like just catching that current in a river, and you don't have to do anything. You don't have to paddle. You just ride along and enjoy the ride. It's the peaceful part of a whitewater rafting trip. If you've ever done one in Colorado or any of these other whitewater rafting locations, you don't want to go through the whitewater rafting other than it's kind of fun. When it's with your money, it's not as much fun. When it's just peaceful, enjoy the ride and enjoy the trend, you ride along it. And we got some setups for that right now. And the key thing for me when I'm looking for a trend is to follow the simple moving averages. All right, so a simple moving average is simply, pun intended, the average closing price over a recent period. Common examples, people take even numbers, even though they don't necessarily make sense because you have 5 trading days a week, but 22 trading days in a month on average. But people tend to look at the 10-day, which is 2 weeks, 20-day, which is 4 weeks, 50-day, which is 5 weeks. Now we're starting to get into kind of random numbers, 100-day, which is 10 weeks, and 200-day, which is 40 weeks. You know, it's not necessarily the most logical numbers, except for that they're multiples of each other and they're really round numbers, and people like round numbers. So they look at round numbers, and because people look at them, they work. The key here to understand with simple moving averages is that every time you have another person following that number, that's another person that's trading based upon it. And that's another person that is making that signal work better. So if the 10, 20, 50, 100, and 200 are the most common, then every time somebody's doing their research and they say, oh, the 10, 20, 50, 100, and 200 day are the ones I should follow, it means the 10, 20, 50, 100, and 200 day are the ones that work, quote unquote, the best. Now, with some extra work, you can find ones that are a little better, which I will be showing you here in, I think, 2 slides. But generally speaking, these are the ones that people look at on their charts. for ones that they look at on their back-tested systems, things change a little bit, little tweaks to find ones that work a little better, even though they're close. The idea with the trend trader is that you want to be long a stock if we are above your key moving average, because it means the average buyer over that period is making money, and short if you are below, or flat if you're below. So we don't have everybody that trades long and short. A lot of people in the market just trade on the long side because over the long horizon, the market goes up. So a lot of people, especially in trend following systems, ignore the short side. I think that there is value to both if you can structure it correctly. But today we're going to focus on the long side because that's what really tends to be a little bit more popular, a little more common, and it tends to work a little bit better over the long horizon. The short side does tend to help pull or hold off on some of the drawdowns, but it's not necessarily as big of alpha generation in the stock market itself. When you're dealing with commodities, bonds, et cetera, that can sometimes actually create really nice revenue potential on the short side, but in stocks themselves, especially the big indices, it's a little tougher to capture that alpha. All right, so with all this in mind, let's look at the moving averages right now. Let's just get right into it. This is the S&P 500, and I'm going to tell you the colors and what they mean. Because right now, this chart might look a little like a jumbled mess to some of you. Others might just be like, oh yeah, I know exactly what we're dealing with. So those that are familiar with my charts, you know that the green and red bars, those are just bar chart for the daily range of the stock. Green days are days we finished higher than we opened. So the close is higher than the open. Red days is the close is lower than the open. The open is the little tab to the left. The close is the little tab to the right. So you can see these big ranges on days like here in mid-December, where we had an open, a big range to the up, a big range to the down, and then closed really close to where we opened. That doesn't look like it was much of a day, and yet at the same point, we had a really nice range that day, about $10 in S&P 500. So 100 points in the SPX. Right now, we've got the chart, and it actually got a little bit better. I did this about 1 o'clock. So a couple hours later, we're closer to a little over 400 in SPY, which means we are above the 10-day moving average, which is in purple, which is the average closing price over the last 2 weeks. We are above the 20-day moving average, which is in green at 389.87, which is the average closing price over the last, call it a month. We're above the 50-day moving average in blue, 100-day moving average in yellow, and 200-day moving average in red. What does this all mean? It means that people buying at basically every price point, every time frame on average, are kind of making money right now. So the people that have been averaging into a portfolio for the last 2 weeks, they've made money on those trades. They sit back, they relax. Those that have been buying in over the last 100 days are feeling really good because they've gotten, a $15-ish appreciation. So there's that 5-ish%, 4% over the last 5 months. And they feel pretty good about their portfolio performance. It's not huge. Average annual performance of the S&P 500 has historically been around the 9-10% range, but you're still not doing too bad. The people that have been buying in for the last 200 days, so now we're talking about 10 months, they're only up a little bit, but they're finally starting to get a little bit of relief, feeling like they had that weight lifted off their shoulders, especially relative to where we were at the end of last year, 380 versus call it 400, so down about 5% and getting that relief here. The problem we've had is that generally speaking, when we've gotten above the 200-day moving average, we've failed. We failed at the end of November. We failed in the middle of December. We sort of failed in the middle of January, but now we're going again. And now that we've got the 10-day moving average above the 200-day moving average, short-term momentum is clearly higher than long-term momentum, which is actually kind of positive for the market in the next few weeks or few months. We're seeing buyers since the beginning of the year. You can see if you look at this 10-day moving average, the slope was downward into the end of the year, and now it's upward. That's telling me that people are buying in. And when I see the 10-day moving average cross the 200-day moving average, it tells me that there's some aggressive buyers right now. So there's more aggressive buyers than passive buyers. I think of the 200-day moving average almost as like the 401k investment. It's just people that leak into the market every month. And the 10-day moving average is the active trader. So the active trader right now is pushing the market back up, and it's going to give confidence and momentum to the long-term investor and give everybody a little bit more of a lift. Now, of course, fundamentals can always disrupt this if earnings come out really terrible. If we have a huge interest rate hike, if we have something go on in Russia, Ukraine, anything could really change there. I do have a quick question here that came up. It's why do I use bars instead of candles and Heikin-Ashi bars? Generally speaking, I like these sort of simple bars because, again, it's similar to like the 10, 20, 50, 100-day moving averages. It's what a lot of people look at. So when I'm looking at my charts on the whole, this is how I look at my charts. I look at my chart in the sort of, it's not the simplest form, but it's in a form that a lot of people would tend to look at so that I can get the picture that the general public, general investment group is looking at. So I try to simplify everything for my chart views and then do all my analytics on the back end where I'm not looking at charts and trying to overcomplexify it for myself. I let Excel or Python or whatever do my back end analytics and then kick out some analytics for me that I can then utilize for my actual trading as well. All right. And that's where the triple moving average really kicks in here after saying that. So when we're talking about that short-term moving average versus medium versus long-term, I use a system that helps me define who's in control and then identify what a stock's momentum looks like. That's what the goal is of these simple moving averages. I can compare, in my case, I like to use the 22-day moving average, which is a month, 89 days, which is 4 months, and 148-day moving averages to achieve a relative value of the stock and these three moving averages to signal when a stock has found a new trend. So when the stock price is above the 1 month moving average and above the 4 month moving average for both of those levels, and then above this kind of 6 to 7 month moving average, it tends to work pretty well. So when I kind of repurposed some of the same colors, but I used my, we'll call it stoplight system here in terms of coloring. When green is above yellow is above red, that's great. So invert your traffic light. Green is the 22-day moving average, yellow is that 89-day moving average, and red is the 148-day moving average. Green above yellow above red is really good sign for a trend, especially when the stock is above all three, of course. When green is below red, like right now, and yellow is below red, like right now, it's a little wishy-washy. So maybe there's some swing trades in the short term, but a trend potentially coming. We have not had yellow above red in the last 6 months. We briefly had green above both mid-December, but then in the end of the year, I think tax loss selling and some other, of course, fundamental factors like interest rate expectations started to hit the market. Right now, green, that shortish 22-day moving average is about to cross back above red. That's going to give some the stock market momentum. You can see that yellow has kind of been down and then flat and then down, and then flat. And right now, if that starts to go back up and we start to see a little momentum in this market, I think we could really see a new trend for this year. And because money flow is often a little looser in the beginning of a year because you're not necessarily printing your end of year results like you did here. All these investment managers had to just kind of close the books and try not to lose more after a stock market year that was not particularly positive. I think this year we could start to see this green and this yellow start to positively move and drag up and create a positive new trend for the year. So when I say that, I mentioned at the beginning, one of my goals here for you guys today is to try to find some of those sectors or some of those individual stocks that could benefit from that. We're going to come towards those at the end. I do want to make sure I cover a lot of the bases of how we identify them before I get to them, because if I just give you names now, you don't necessarily understand the justification other than this moving average system that I just mentioned, but there's more to it than that. All right. And that's where the short term actually comes in. As you go down that creek that I mentioned before, sometimes you come to a fork. One way you can see to the right there, I can see a little bit of the white water. To the left, might see a little white water. Which one's scarier? Which one's cleaner? You might just have a little white water move and then everything is fine again. To the right, you might have really bad rapids to left. You could do the extreme of the analogy of a waterfall or whatever else, but you guys get the point. The whole goal is to try to find that clean, easy to follow path. With short-term options, I have two ways to follow that path. I can sit there and say to myself that, 50-50 left or right, but I know I'm not going straight because that's straight into the rocks. So that creates a different opportunity for me where I can have a big risk, but big reward. If I get in earlier, because right now it's uncertain in the market, which I just mentioned, maybe I can capture that first 5% of the move that a trend following system may not quite capture. So how do I capture that? Well, of course, being option hotline, I use options. What's the signal? Well, I use a technical signal usually. And the one I'm looking at right now is called a rectangle. It's basically a long consolidation period and telling myself, you can go up, you can go down, but we're not going to be right here in the next month or two. Okay. So when we're testing the highs of the range, like we are on the S&P, we're likely to either go up and set up a new trend or go back down to the lows of the range and then continue the chop. We don't know today if we are at this point-ish, kind of a potential breakout, or if we're around this point where we've got another month or two of chop. So how do I accommodate for that? Well, the biggest thing is to set my price targets and my stop losses and try to figure out where my risk is, because then I can calculate whether the reward is worth investing in options. So if I'm thinking, let's get in here in the stock market as we test this potential breakout, what I want to do first is to set myself a stop loss saying that if we go back to the lows of the range and break through them, we're clearly not going any higher. Right now, this market is actually maybe turning into a bearish market, this chart instead of this chart. And it's unclear right now which one we're in, because we're not in an uptrend, we're not in a downtrend, we're actually just in a pure consolidation. If I go back for a monthly chart, clearly we're in an uptrend. If I go back for like a 9-month chart, we're maybe in a downtrend. So to me right now, it's not clear if I'm in this sort of setup or this, but what I know for sure, or with a reasonable element of expectation, is that we're probably not going to just hang out here for the next 2 months. All right. So I'm thinking to myself, if we go back to the lows of the range, and S&P right now, maybe it would be around the 375 range. So what is that, about 6% lower? I don't really want to be in the market anymore. If I'm long, I'm out. If we go below 375, I might start to look at betting on a bearish bet. And if we keep going higher above 400, 405, it starts to give me some confidence that I found the new trend to the upside. On the other side, we have the profit target. If we have a clear breakout to the upside where there's not really been a lot of trading above current levels, what's the resistance of the stock market or an individual stock? It's unclear to me. So I have to use some sort of statistical analysis. All right. So I go in and I say, okay, well, options kick in. I start looking at implied volatility, historical volatility, because this is built upon the historical average movement of a stock. And if a stock's volatility is, for example, 16%, it means that the market is expected to move about 16% in a given year. And then that can be dialed down to a daily average move, a monthly average move, a quarterly average move, depending upon the time frame of my trade. I can get into some of the specifics of how that math works if you guys want. Email me, keith@optionhotline.com. It's a great little mental exercise and always kind of fun for me to go back and run through some of the daily, weekly, monthly expected movements in certain stocks, because frankly, that's what you trade in an option. You're trading that expected movement up or down. And then by adding in this technical element, we're picking the direction that we think it has more explosive potential. So a standard deviation, for those that are not familiar, it's a statistical measure saying that we expect a stock to trade within one standard deviation of current prices 68% of the time, 34 plus 34. So with 68% of the time, 2/3 of every trading day, we expect the stock or the market or whatever to trade within one standard deviation of the current price. It's a little off because technically we have a little bit of a skew to the right, which means we expect the market to go a little higher and a little more risk to the downside. Big moves tend to be down, not up. When you get into individual stocks, it can actually flip because you have takeover potential or FDA announcements. But generally speaking, with the market, we expect a small up move and have bigger risk of a big down move. When people start talking about moves more than really 2.5-ish standard deviations, throw it all out the window. The market does not move in a true normal standard deviation. I've seen too many times on financial news networks, people talking about a stock market move being a once in a million year occurrence. The reason that it looks like a once in a million year occurrence is because normal standard deviation is not actually absolutely correct on those wing moves. Okay. So big moves happen more often than normal says they should, which is fine. I mean, just something that we have to price into our modeling when we are dealing with stocks. Now, when I see that rectangle setting up, I start to think about a different type of distribution, which is called a bimodal distribution. So let's say the stock is here at the high. I think there's a good chance that we have a good size up move and a smaller chance of a down move back to previous support. So we have that big up move or the small down move, but we're probably not hanging out here. That's what this distribution is trying to imply here, is that we have a good move, one direction, high probability, a slightly lower probability move down. You still have some breakout risk to the upside, breakdown risk to the downside, but generally speaking, we're reducing the probability that we stay right here. This is where options come into play, because now you look at options, they price in this kind of distribution, and I'm saying we have this kind of distribution. So if we have a different distribution from where the market is implying, we have an edge over the marketplace. We can try to figure out a way to leverage and define our risk in such a way that creates positive expected value. And that's the entire game of trading, right? Finding positive expected value. Doesn't mean I'm going to win on every trade. If I win on 55 or 60% of my trades, that is a Hall of Fame trading career, as long as my expected value is higher. And I can have a Hall of Fame trading career, by the way, with a 30% expected chance of winning. The reason is because if I could create a situation where 30% of the time I make $5 and 70% of the time I lose $1, I'm still expecting to make money every trade I put on. So I want to make sure that every time I put on a trade, I expect to make money. If I have this setup, I can figure out a way in the options market to expect to make money on every trade. Reminder that options have risks. We do have an incremental increase in transaction costs. Options often have higher commissions and fees than stock trades because they are higher risk and they do represent more shares in general. One call option represents the right to buy 100 shares of stock, but not the obligation to buy 100 shares of stock, but it gives you the right. So one option, 100 shares versus 100 shares, and you do it a lot cheaper. Options are cheaper than the stock. They have to be on the call side by definition. Because if you could buy the stock cheaper, or if you could buy the stock cheaper than the option, you would buy the stock instead of the call. Assignment risk is there. The strategy I'm going to talk about today actually does not have to worry about assignment risk because I'm only going to talk about buying options today. It's frankly easier for most people to understand buying options. And when you sell options, you do add this assignment risk. It can create some really crazy concerns for margin and things that I just don't have time to get into today. So we're going to focus on a buying option strategy for the potential market move to the upside. Options decay in value over time, and that is an incremental risk for only buying options. Buying options is like buying insurance contracts, whether to the upside or downside. If your stock doesn't move to the upside on day one, you have fewer days to have that payoff, which means it's worth less than it was the day before. So that's why options decay. Every time days pass, you have less days for it to work out. So they have to become worth less. Volatility can be both positive or negative on that. When volatility goes up, it's telling the world that you expect the stock to move more, so options become worth more. And when volatility goes down, it's telling you that the world thinks the stock's going to move less, and options become worth less. So volatility is constantly changing. It can go up or down, just like stocks. And this is a big thing that options market makers and proprietary traders and hedge fund traders really focus on throughout their careers. And this is where I really, cut my teeth in the market, was focusing on volatility. So for those of you that have been with us before, I'm just going to do a brief commentary on options because I want to focus on the actual setups that I'm looking at now, but I have to give you kind of a brief commentary on options so that you understand why I use options instead of stock in this bimodal distribution, rectangle breakout kind of world. Okay. So let's say you have a $100 stock with a $120 price target in the next month. If I think that if the stock goes below 90, I need to get out because it tells me I'm wrong. And if the stock goes to 120, I hit my price target, then I have a pretty good risk reward profile, right? I expect a $20 upside move and I'm risking 10 to the downside. The question is, what do I think the odds are? If I think it's 50-50, 50% of making 20, 50% of losing 10, I have positive expected value. Very clear. Expecting to make $5. This stock should be worth 105. If I'm wrong and I think that the stock to the upside is only going to happen like 20% of the time and downside 80% of the time, this is a bad trade because 20% times $20 is $4. 80% times losing $10 is $8. I would actually expect to lose money. So, you got to understand both the expected upside and downside and the expected probability of success versus expected probability of getting stopped out. The other thing you have to focus on when you're going into a stock trade is that the targeted max loss is $1,000, but there is a max loss of the entirety of what you put in because any stock could go to zero. Nobody ever thought Goldman Sachs was going to go to zero for the longest time. And then during the subprime crisis, when I was on the floor, I remember people were buying the $5 puts for 60, 65 cents, basically putting this massive probability on the chance that Goldman Sachs could go bankrupt overnight. Warren Buffett came in to save the day. Didn't happen. We were close. Okay. And this was like, you can look at Goldman Sachs stock price right now. It is currently a $350 stock. I don't remember if there's been a split since then, but we were talking about a real risk of this massive company going to zero. Stocks can go to zero given the right scenario. So always keep that in mind. The next chart will show a little bit more about, somebody asked about decay. Just want to show you guys here. Stocks, the options do decay here, and a little bit of that can be seen here. If you could buy a call with a $100 strike price expiring in 1 month, but you have to pay $5 for that, then you can get leverage in exchange for decay. And you can get defined risk in exchange for decay. So if the stock doesn't go up, I lose the $5 I paid. And that gives me the right, but not the obligation, to buy the stock for $100 per share over the next month. And a lot of people would say, well, if I wanted to buy the stock for $100, why would I put a $5 premium into that today instead of just buying the stock? Well, I could buy 2 calls for $5 a piece, which would cost me $1,000 because I have to multiply it by 100 since I'm representing 100 shares per call. So I can have control over 200 shares instead of 100. And then if the stock went to $120 a share, those calls are worth $20 each. So for $1,000 minus my initial $1,000 paid, $3,000. So 100 shares is worth $2,000. 2 calls is worth a $3,000 profit. I make more money on the upside. Similarly, if the stock goes down to say $80, I only lose the premium I paid. So I'm defining my risk. And over time, these calls that were initially worth $5 slowly drift down in value. They go from 5 to 495 to 490 to 485. And then they start to accelerate as we get closer and closer to expiration, because a day matters more when you're only a day away from your insurance contract expiring than when you're still 3 years away from it expiring, as an extreme example. All right. So decay accelerates. It's got that parabolic decay. And that's what we're seeing here, is that if you get to expiration and this stock has not moved, I'm going to lose money. I need the stock to go over 105 just to break even. And really, I need it to go up towards that kind of 120 level to feel good about myself. 110 would be the break even relative to stock. And that's what we see here. So you can compare it. If I think a stock is not going to sit where we're at, it's either going to go way up or way down, I would rather buy an option than buy the stock. That's that bimodal distribution I mentioned earlier. So that's why I think options can really play out well when we're testing the edges of a range. Yeah, there's a chance that we go down back to the lows. And if I hold my call option and it expires worthless, I'm going to lose some money, but I'm going to lose less or maybe the same as if I was long the stock. But if I'm right and we go to the upside, I can make a lot more money. The concern is if my technical analysis is wrong and we just sit, then I lose a bunch of money that I wouldn't have lost if I was long the stock. But that's the risk that we take in the market, right? We're always giving ourselves a trade-off for a better potential performance. So right now in this market, I don't think we're going to stay here. I think that's a low odds of occurrence. Still, there's an odd that it happens. And I'm looking for either a big up or a bigger down move. All right. This is what I tend to outline in my outlier watch list. So this is a great starting product for a lot of people because it gives you guys a list of stocks that I am looking at for potential short-term big moves or potential long-term trending moves. I can tell you right now that my list had 31 stocks on it this weekend. All right. So I give it out every week, once a week. It shows what I'm looking at, why I'm looking at it, and what's the trigger for me to get interested in getting into these stocks for our trading portfolios. It's $97 a quarter. So it's less than or just about $1 a day, significantly less than a cup of coffee these days. It's what is that? About 15 gallons of gas. Fill up your gas tank once and you're probably pretty good. Now it's a little more than that now with gas coming back down, probably about 30 gallons, but still, it's not a bad, price for a quarter when you're dealing with something that can help trigger some ideas and alerts for you to kind of, think through the markets. The swing trading candidates in the first 36 months were up 142%. The trend trading candidates, that model portfolio for the ones that I executed, the model portfolio was up 110% in 33 months, started a couple months after the swing trading candidate portfolio. So you can see that these things do tend to work. Close to 50% a year, a little less, but still a very strong market candidate for using options to help get some leverage and some defined risk into your portfolio. So I urge you to go to optionhotline.com/outlier to take a look, see if it's of interest to you, and try it out for a quarter for $97. It's not a huge amount of risk to get started into the market and getting a new piece of information that could help you with your trading. Now, with that in mind, I do want to now touch on the markets in general. The 1%, sorry, I do have a question. The 1% rule for buying options. Sorry, Jeffrey, can you expand on which 1%? I mean, there's so many rules for buying options, and I'm not sure which 1% one you're looking for. If you don't mind expanding on that, I can come back to it in a little bit here. The first thing I wanted to touch on was the reason that I started talking about outright long calls for the breakout rather than spreads or something else. And that is that the VIX is generally very close to lows. Clearly, we did see a lower level in the VIX about a week and a half ago. We did see a little bit of a spike as we get close to earnings season. But generally right now, options are not very expensive, and we could see some really good leverage when the VIX is low. The VIX is the average expected annual move, again, in the S&P 500. So if we're expecting sub 20%, that's about as low as we've seen in 6 months. I'm not as quite as worried about the implied volatility risk of buying options when the VIX is low, although the VIX does tend to go up when the market goes down. All right. But if I think we could have a really big leverage move to the upside right now, I can actually take advantage of that by buying call options right now. So let's look at SPY. I mentioned this earlier, looking like it wants to start a new trend move, but we do need to see some of those mid and long-term moving averages. Well, the midterm get above the long-term and the short-term is already above both. So that's a good sign here. The short-term is getting above the 200-day moving average here shortly. The midterm needs to come up a little bit more. It also has a little bit of that rectangle feel to it. If you look here, I'm going to just do a quick draw. You can sort of see this rectangle kind of look overall where we've been slowly consolidating here between about 375 and 400, and looks like we want to break out now. Limiting the time value to 1% of the premium. Yeah, so that, Jeffrey, would apply, to read out, the 1% rule says to limit time value to 1% of the premium. So daily decay to 1% of the total premium. That is a strategy a lot of people use so that they don't take too much daily market movement risk. And I understand why some people do that. I tend to move away from that overall just because of time trading and everything else. And if you're going to do a 1% rule, you're going to have longer term options. So if you're trying to capture a quick move, you want to shorten the time to expiration. So what I do when I'm dealing with shorter time to expiration is I cap my total premium risk as opposed to looking at my theta risk. So I say, I'm willing to risk $200 on this trade. I'm going to buy $200 worth of options. That way, if the stock goes down, I know that's the most I can lose. I don't worry about it as much in terms of theta. I worry about it in absolute max risk terms in case of a gap down or absolutely no movement. All right. So SPY, I think, is getting close to potentially setting up a trend. If I look actually another just completely different sector, and most of us have probably seen the Bitcoin move and what it's done to precious metals as well. Gold has been getting dragged up. You can see again that rectangle here that occurred in the late part of the year. Oops, that's a little low, but you can sort of see it here between the 160 and 170 range. And then we finally broke out right at the beginning of the year, started to rally, and we picked up $10 in gold. So a good 5%. Now, one of the things that I like to do is I like to look at commodities because I think that they're a very interesting field. And I also traded gold and silver as a market maker on the NYSE or NYMEX for years. I think this is a really interesting field to look at right now because we are in an upward trend. But if the dollar starts to firm, this could flip quickly and we could see gold start to collapse. Or gold could do what silver has done and get that early move up and then sit. So silver right now is in that pure rectangle. If gold keeps going up, it sets up silver for that breakout move from a rectangle. If gold and Bitcoin interest starts to wane, it could set up silver for a bigger drop down towards, say, even as low as $18. So I'm seeing both directions here right now in gold and silver. We've got a trending move higher in gold, and we've got a consolidation period in silver after an earlier trend higher move. This makes it really interesting for me to play precious metals from either side. I can start to watch for gold to drag silver higher, or I can look for gold to stop moving and silver to potentially collapse and then drag gold right back down. Usually when we have a real bull market in precious metals, silver actually performs better than gold. So what we're seeing in November and December made a lot of sense for maybe the precious metals bull, and starts to make you a little bit concerned if you're a precious metals bull today because silver is lagging. And Jeffrey, sorry, I see another comment here. To get to that level of not worrying as much about theta, you have to be so deep in the money that the premium is too expensive. It really depends upon how your trading strategy is built. So we have trading strategies that I utilize for myself that trade out of the money options that would probably violate, quote unquote, the 1% rule in terms of what I said, because that's where the premium is my absolute. And then I have trading strategies that use in the money options with 3-ish months to expiration, and those options can often be executed in a lot of stocks and a lot of indices for under $1,000, under even $500. I mean, if you have a $20 stock, you can very much bring the premium level down. Of course, it's a lot more difficult when you're dealing with even SPY as a $400 ETF to trade a $20 in the money call option expiring in 4 months. It's going to start to add up a lot really quickly. So that's part of the, I guess, joy of trying to create a trading strategy using options to try to pair the amount of dollars you want to risk per trade with the right strategy, with the right underlyings. And so that's, a lot of what we do with the outlier watch list is try to pair all three of those, knowing that when I look at a stock and I want to risk $200, $500, $1,000, $2,000, something like that, I can try to find stocks that fit my system. Okay. So yeah, that was the precious metals sort of summary here. I think that silver is in this consolidation mode, could have a big move up, could have a big move down. Gold right now is clearly leading. That's actually almost concerning to me for precious metals. Now let's go to the actual names that are going into this outlier watch list now. All right, so I'm going to give you one preview that's on the watch list. It's been on the watch list actually since November, when it first started to break out from this previous rectangle that you can see here from August into November. Monster Energy broke out, had a nice run until the end of November, and has been in this consolidation period since the end of November until now. Couple months here, looking for that potential breakout. If it goes to the upside, all of a sudden, this has that new trend feel. And when the market goes to a new bull trend, it's going to put a tailwind to basically everything. And I think that could be a really nice positive boost for Monster. So this is a stock that I'm really watching for a breakout if the market starts to get a new bull trend. If the market does not find a new bull trend, it's a little more difficult to bet on the breakout. But I could do it with short-term options to define that risk for a quick move. Or if I really believe in the market, I could start looking at that trend. And so I could do the short-term move with out of the money short-term options, or a long-term move with further dated in the money options. And either way, I could actually really leverage a potential movement here in Monster, especially if I get a good trend move in the market. So I think there's a lot of good defined risk here. And just something that I'm really looking at, because we've now had a period of consolidation that's over 2 months. And when I see a consolidation period of over 2 months, I start getting really excited. I mean, that range there is effectively 99 to 10. I'll give it to 105. But we're talking about a 4 or 5, 6% range over a couple months in a stock that can move. That's exciting. Now let's go to an entire sector that has a very similar move to Monster, but even longer. And that's biotech. I teased about this a little bit in my blog post this morning for those that saw it. XBI, we're going to use this as our proxy instead of IBB. Both are good. If I draw in the range here, I mean, you could just see it. It is a minimal move for the last almost full 6 months. Very little, and just starting to get going. And then on top of that, if I just delete this just to make sure you can see it even more clearly, remember, purple is my 10-day moving average, green is my 20, blue is my 50, yellow is my 100, and red is my 200. We have stacked all the shorter term moving averages above the medium and longer term. We are looking like a trend is forming after this long period of consolidation. This gets me excited. If the market does continue to firm, biotech looks like it's a really good source of potential in the market, especially given that we've been doing this rally really since the beginning of the year. So money managers seem to be looking for biotech as a way to allocate their capital. You can see on top of that some of the big names like Gilead had a huge move near the end of the year and then have been consolidating or sitting. So what we're seeing here is that those big names, some of the biggest would be Amgen, Vertex, Gilead. Gilead's, I think, the biggest right now, already had a big move into the end of last year and then sat. So right now, it seems like money managers are looking for the other biotechs to allocate capital to trade that next wave higher in this industry. This gets me, again, super excited. And then this is the name that I think has maybe some of the best potential on a technical basis of anything that I'm looking at. Will be in my outlier watch list this weekend, and that's SGen. And that is Seattle Genetics CGen Incorporated. All right. And if you just look at this, I mean, we've had no movement really since the middle of September. If this gets just a little more wiggle higher, we're testing the 200-day moving average. This is a stock that I've seen in the past trend higher for months and months and months. It could be a really explosive setup. And with implied volatility low, I can define that risk. So I am looking to define my risk always set my capital losses at the most I'm willing to lose. That is always my priority, is to take risk over reward. And then I think that this could create a really nice explosive setup. It's going to be on the outlier watch list this weekend. MNST has been on the watch list. Gilead had been on the watch list. We've got a number of names that go on that outlier watch list. And I think it could be worth your time to take a look, think about those names, look at each of the individual setups, look for those rectangles, look for other technical setups that we couldn't talk about today because we're all limited on time, and try to figure out what works best for you in terms of trend trading, swing trading, or otherwise, in order to help improve your portfolio performance. And optionhotline.com/outlier, take a look today. $97 for a quarter. So that's 3 months for $97, about $1 a day. Weekly watch list that just, I think, might help a lot of people set up their portfolios by filtering down the market from thousands of names to about right now 31 names that could be of interest to you in the coming week. If you have any other questions, contact me, Keith at optionhotline.com, 312-608-004. Again, webinars at optionhotline.com for the free giveaway. If there are any other questions now, please throw them into chat or Q&A. And if we are out of time, email me. It'll be the easiest way to get a hold of me, and we can resolve any questions at that point.
Thank you so much, Keith. We do have a little bit more time, and we do have a few questions ready to go. I'll ask you to keep your contact info visible just for the next minute or so. Ray asked a question stating he's attended lots of webinars where the presenters are preaching selling options as opposed to buying. He would love to hear your point of view, on selling options versus buying. And Vic is also joining him with that same question. He'd like to hear your point of view as well.
Yeah. So with selling options, you tend to increase your probability of success, but lower your risk reward in terms of the payout. So let's say you sell an option for $2, the max you can make is $200. But if you're selling, say, a 30 delta option for $2, you're expecting that you're going to make money 70% of the time versus losing money 30% of the time. So a lot of people focus on probability of success more than just the total risk reward. I like to look for the total risk reward. And I think a lot of the option hotline experts have done a really good job of filtering out those selling option setups that are really good for still a very high positive expected risk reward. So don't get me wrong on that. Using spreads is an exceptional way to do that because that way you've defined your risk still. I just like to look for the options, especially in this current market environment where the VIX is near lows, where I really want to be buying options to try to play out some leverage when the market setup is there. Over the last 6-9 months, even, we've had a pretty range-bound market, and a lot of those selling option strategies have been very, very lucrative. So it's a little bit of balancing your portfolio towards your comfort level. I do tend to be more comfortable with buying options, given that I started my career right when the subprime crisis started. So we had the massive collapse in the market, and buying options was the only way to make money. Others have started their career at various different points in the cycle. for the market, and they find ways to make more money on the sell side. So yeah, I think both can work really well. I just look for expected value on the buying side, especially right now. And I think that there's a lot of potential there.
Great. Thank you very much for that thoughtful answer. We have another question from Vic. He asks, is it true what they say that more than 90% of options expire worthless? If so, seems like we're at a much higher risk of loss. What strategies, if any, do you suggest to improve our chances?
I don't know. I mean, I haven't done a statistical analysis on 90% of options expiring worthless. But I can tell you that effectively, and this is something you can kind of play around with, it's not exactly correct, but delta, if you can see that on your trading platform, is a proxy for the odds of an option finishing in the money. So if you buy a 20 delta option, you expect to make money, or sorry, you expect for it to finish in the money 20% of the time. There are a lot of options that are 10 delta or less. So it might be true that 90% of options expire worthless, but a lot of times they already were started off at like 1 or 2% odds of expiring in the money. And frankly, they were unlikely to happen in the first place. If you're looking to improve odds of finishing in the money, generally speaking, increasing the delta increases your odds of finishing in the money. The problem of that is, of course, that increases the cost. So the other thing you can do is trade spreads, like a call spread. If you go to our historical webinars, you can see maybe a previous webinar of mine, I believe the June 16th webinar. I spoke a little bit about call spreads as a strategy, as a way to reduce your outlying cost and improve your odds of success. I've had other webinars in the past that talk about increasing odds of success simply by increasing the delta of the option you are buying. And that would generally be my normal way of handling that.
Wonderful. Thank you. Appreciate the answers. And thank you, everyone who asked such really, really insightful questions. And I know Keith addressed a good amount of questions actually during the presentation that came through. So we appreciate your active participation. And Keith, thank you for going through and answering all of those. We are pushing up right against our time frame here, but Keith did show his contact information. We have one more question coming in. I will read this out, but hopefully Keith can maybe reply via email, or Ray, if you can email Keith directly at keith@optionhotline.com. He's asking Keith that I don't understand how the deltas apply to buying options. So perhaps you two can connect after the webinar.
That might be
a
the
little
best
bit on that.
Yeah, so if you want to email me, keith@optionhotline.com, we can kind of go back and forth a little on that if there's follow-up. But yeah, it's generally speaking, the delta is the expected odds of an option finishing in the money. So we'll start with that, and then we can follow up via email, if that works for you.
Okay, great. Thank you, Ray. Thank you, Keith. I do have visible here on optionhotline.com's website the outlier watch list page that Keith has mentioned. He showed you a couple of actual stocks and sectors that are going to be featured on the outlier watch list this week. So go to this page, click add to cart, and sign up. $97 for 3 months worth. Get a lot of great information for you to make some moves on. Keith, thank you so much for taking the time. Fantastic presentation as always. Thank you for everyone who took time out of your lives to be here with us and to ask such insightful questions. We love it. We appreciate it. And we hope to see you back at our next educational webinar. Let's go to the webinar page here. Keith is going to be back presenting to the Option Hotline audience in February on, what date is here? February 15th. So after you subscribe to the Outlier watch list, go over to the webinar page and go ahead and sign up for his February webinar. Keep an eye out on your email inboxes tomorrow for an email from webinars@optionhotline.com. You will receive the record to replay link, also a free gift from Keith, and additional information on that outlier watch list. Thank you all so much. We will see you back here at the next Option Hotline free trading webinar. Have a good one, everyone.